First thing, financial literacy, the safety guards, and market context. Before we even think about executing a trade or buying a stock or ETF, we need essential guardrails in place. I call this measure twice, cut once, personal rule of finance. You need a safety net. First, your emergency fund. This is absolutely non negotiable. You should have at least 3 to 6 months of essential living expenses. I'm talking about rent, mortgage, groceries, utilities, transportation, saved up in a separate, easily accessible high yield savings account. If you're married and you work at the same place, or you're married and you have one earner in the family, um, you will want to have 6 to 12 months of emergency funds build up available in cash in a high yield savings account. As your risk is higher if one person wants to lose their job if you both work at the same place, or as it's much higher if you only have one earner and that person loses a job as well. So single people or people who are married with dual incomes from different places, 3 to 6 months. If you are married and you work at the same place, or you're married and have a single income, you want 6 to 12 months of emergency savings saved up. That's the first part of blocking and tackling, right? Second, your high interest debt. If you're currently carrying high interest debts, I'm talking 18 to 20% in credit card fees or loans, it's costing you a fortune every month, especially if you're not paying it off. That's what I mean by carrying a debt. You're not paying your balance down to zero every month. Paying off that is a guaranteed return on investment. Some would say a better return than stocks or any stock bet that you can make. Prioritizing paying down that bad debt before aggressively investing in the long term. To contextualize, if you're paying 20% in credit cards, the stock market in the last 3 years has done about 25, 23, and 17% respectively in returns. So that's a little framing for it. Third, maybe most importantly of all, mindset. Stock market can and is volatile, choppy, turbulent, fickle, sometimes angry, sometimes happy, sometimes jubilant. It's a very temperamental instrument. Just look at 2025. The S&P had a fantastic run from April through the end of the year, gained a total of over 16% for the year, rewarding long-term investors. But I don't know if you remember about this time last year, or early from February to April, it got real rocky. We saw some turbulence in the market. We saw as the market was being economically detoxed, which we're still in the process of, global tensions, tariffs, geopolitical situations, all those type of things play into the volatility. And we just saw a shaky start, which is a perfect reminder that markets don't go up in a straight line. Trees don't grow to a straight line either. So remember that. Investing is a marathon, not a sprint. We're aiming for long-term compounding growth, generally over 5 year or more horizon, right? If you need this money in the next 12 months for a down payment on a wedding or a down payment on your house, you're not investing in stocks, not all of it in stocks. That's not an appropriate place for those type of funds. If you have your kids' college fund that you've had in the 529, you probably want to change the allocations in there. But what we're talking about is we're building wealth slowly, deliberately, and smartly. Understanding that short-term volatility is normal. Getting started.